Thanks, Shripati. And Praveen actually is here in his hat as an iSpirit volunteer. You can come closer to me. I'm not so dangerous.
Thanks.
Great. So we'll start. So this is a panel on lending. I think there was a lot of talk about payments, which is going to take a lot of transactions digital. And with payments, of course, traditionally payments has been a fee-based business. But now, as it becomes more and more a free business, or certainly an at-cost business, viability of building large companies out of payments itself is quite debatable. And the next opportunity here, which has really been the crown jewels of most banks, has been, or financial services, has been in the ability to lend to consumers or to businesses or to SMEs and make money from them. So we have a panel here. Praveen works with iSpirit and is working on a lot of the volunteer efforts of working with banks on the new world of lending. Gaurav is the founder of Capital Float, and he'll talk about them. They're one of the earliest lending fintech startups in the country. Vinay is CEO of NIYO, which is a salary payroll startup. Again, looking at bringing credit at various points to consumers. And Deepak, of course, Chief Digital Officer at Kotak, which is, as we all know, one of the largest banks here. So broadly, I think all of us are aware of three major things happening in addition to ubiquity of the smartphone and mobile internet. We have Aadhaar and India Stack, which are having a big role to play in the digitization of the country. UPI from a payments perspective, which is part of the India Stack. And the combination of these is going to mean that India is moving to a data-rich country, and that's where we believe there is a foundation for lending. So Deepak, I'd like to start with you. You're at a large bank here and leading the digitization efforts. Would be good to know about some of the recent initiatives. I know several of us saw the ads for 811 and things like that. So what is the view of the bank on these new opportunities that are emerging?
So I was just mentioning in the earlier session, as I was setting a trip to Bangalore, we just launched all the fly credit in 811. That was just launched day before yesterday night. So it's only been less than 48 hours, wherein less than about 3 minutes as you open 811, you can also get a credit card approved online real time. So we have taken a first fly to credit, not just for customers that traditionally banks were doing, but even for non-customers doing a real-time credit. Backed very soon with also a virtual credit card, physical card. You can do on-the-fly transaction in less than 4 minutes, so as to say. So I think this is just one of, I would say, the indicators of where things are moving. The second indicator is for our unsecured loan. Till about a year back, we used to do about 10 to 12%, 13% of our lending, which used to be online, because a large part of banks' core lending still continues to be through traditional channels, which is your captive branches or DSAs, DMAs. But we started to shift that, and today, as of September, in fact, 1/3 of our lending has moved to online. So it's not just in terms of percentage, but overall lending itself has grown by 100%. So if you look in real terms, the growth is almost 6 times in 1 year.
Wow.
And so I think there is a definite shift, and the shift is for good. Bringing in more customers in the fold that we couldn't do through physical channel. Taking out all these intermediaries, DSAs and channel, because then you are in a position to directly reach out to customer and serve them. So your credit quality, customer intent, your ability to offer them a better product or a better rate on the fly is faster. And I think overall, even in terms of margin, especially when I'm talking of unsecured loan, the realization is much better if you can do a much faster decisioning. So I think on each of these, our own captive efforts have started to show. Obviously, we have been working with a lot of partners too, in areas like business loan and in terms of the new customer segments. But I think this growth is phenomenal, and I would only say next couple of years, I won't be surprised when 60 to 70% of the core lending business will completely move digital and paperless.
That's fantastic. So Gaurav, you've been one of the earliest fintech entrepreneurs, and I remember meeting you in disbelief, saying this guy has no idea what he's trying to get into 5 years ago. I wish I did not have that conviction then that But it's been quite an exciting journey for you and working as a fintech startup. Tell us a little bit about your business and some highlights in a couple of minutes.
Thanks, Sanjay. So I run Capital Float. It's been around 4 years since we started the company. It's an online lending platform for small and medium businesses. We recently sort of forayed into the consumer lending space as well. We run a hybrid lending platform, meaning we have our own NBFC, so we lend off our own book, but we also co-lend and syndicate with certain banks, NBFCs, large family offices and institutions, thereby obviously creating a marketplace platform where these institutions get access to loans that they typically would not do. I think on the customer experience where we're really innovating is a couple of fronts. One is on the point of access, so going to new segments that typically a bank would really not foray into. So small mom and pop stores, kirana stores, more subprime type SMEs that have sort of remained out of the realm of formal credit. And I think the second is even where SMEs do get a loan, really how do you make the product that they get and how do you make the experience that they get far better and more sort of useful. And that's where we leverage a lot of obviously the India stack infrastructure. It's been about 4 years. We have about 1,000 crore AUM and been hopefully looking to grow that over the next few years.
Great. And Vinay, you're a banker turned fintech entrepreneur. So it would be good for the audience to know, why a banker after 20 years of experience in the banking sector felt there was an opportunity to go outside and build something exciting.
Yeah, thanks, Sanjay. So, yeah, 17, 18 years of banking, both on asset and liability side. One thing I realized very important, because we're talking about lending, I'll stick to lending, is to be successful in lending, the money you give, you have to take it back. Okay. So, we started from there that, when you give money, you take it back. So where do you take it from? And, that was the whole thesis of, our startup. So, if you look at pure data, there are around 70, 75 million odd salaried people in India who more or less are guaranteed to get their salary end of every month. And out of these guys, if you look at the people who are, let's say, credit carded and, where all the banks go after, trying to lend them is around 20 odd million. So you still have 50 odd million who will not get, in a normal scenario, a loan or a small credit line or credit card from a bank. So the objective of the what we're looking at is, can we utilize their payroll, which is the salary they get, that information that on this date, this particular individual is going to get its salary, to start giving him, small credit lines, and then it can vary and increase, as his continuity in the organization increases, etc. And that way, there is a good possibility of reaching 75 million people who will be able to lend. And then hopefully the unicorn is there.
It's funny that when you said, more or less get their salary at the end of the month, I pulled out the water bottle and it said Kingfisher. So
yeah, that we would account for.
I hope that's not on live TV. So, it's really interesting to see, the different views, but, broadly, I think the opportunity is something that everyone believes is huge. Praveen, you've been working with iSpirit, and in the context of iSpirit, working closely with several of the banks and getting some of the larger organizations and some of the challenger banks as well to appreciate, what we have in India. What is so different now, given that India Stack and Aadhaar are in place, that's getting people excited about the size of the opportunity?
Yeah, I think, one of the biggest fundamental shift that's happened is bankers like Deepak, pretty much visit Bangalore at least 5 to 8 days a month. So that's the big shift that's happening. And technologists like Nikhil visit Bombay at least 10 to 15 days a month. So that's a big shift. So what is happening is bankers are embracing technology, and technology people are basically demystifying the kind of opportunities that
I
could
almost
exist.
thought you said technology people are embracing bankers. I think that would be going
No,
too
no,
far.
I mean, that could be possible if, I mean, there is a quote that says, if banks don't become good technology companies will become banks. But luckily for us, I mean, everybody has woken up to the idea that we could use technology building blocks to innovate on the products. If you look at, Gaurav, for example, when, I went to one of the shopkeepers where, they have taken a loan from Capital Float. Traditional bank would have never given them a loan. And the guy is happy he got a loan from Capital Float or a company like Capital Float because his first port of call is 36% local money lender or even more. No documentation, no collateral, nothing. They just see the data and then they're able to basically go ahead and give loans. Deepak alluded to the fact that they're doing those loans. A lot of players will come and they will use data from all these GST, payments data and and Aadhaar and so on and so forth to give loans. So that's what I'm seeing at the moment.
Great. So, data is the new oil, and, we've all talked about that, and we've all seen, humorous reflections of the Geo logo as well. But I think fundamentally we all believe that, with data, there is an opportunity to, create a credit or to come up with the credit worthiness and on the back of that to lend. How much of this is myth versus reality, Gaurav, since you're in the business?
I think a lot of it is very real, right? So as the example that Praveen was giving, we are able to give loans to a Kirana store in under 5 minutes because I get data from a POS machine that he uses or from a mobile wallet that he uses. And in 5 minutes, he's getting a loan of about 50,000 to a lakh of rupees. So it's very, very real. And it's not something that's going to happen in 2 years. It's something that's actually happening today. But at the same time...
Can you walk us through what is the experience of the retailer and where do some of these new digital platforms like IndiaStack come into play?
Let's take an example of a merchant who has a wallet. Let's take an example of a Paytm wallet. We have a partnership with the likes of Paytm where we get a lot of that data through an API, obviously with the consent of the merchant. He downloads a Capital Float app. He gets a pre-approved offer based on certain transaction level data. If he's got a bureau score. If he does not have that, we look at certain other demographic and SMS scraping data again with his permission. And so he's given a loan offer of 50,000 rupees. He validates his eKYC through the Aadhaar IndiaStack platform, which is mostly OTP based. If it's less than 60,000 rupees, if it's more than 60,000, you have a feet on street who goes with a biometric device. Loan is approved. He signs the document again, which is OTP and OTP based e-sign through Aadhaar, and money is in his account in a matter of a few minutes. There's an algorithm running at a back end that obviously crunched a lot of this data and decides whether this person is loan worthy or not. And that's the entire process. Now, obviously, let's not forget that this is fintech. So like he said, you need to collect the money back. So while there's a lot of tech that's really gone in sort of getting to customer acquisition, using data, making the right type of loan, you can't really get rid of, at least at this point in time, certain collection infrastructure that you need in the country. You have to have some amount of feet on street, people who give a call, because there will always be a certain number who don't pay. So that part, a lot of tech is still being developed, but you need somebody to go and knock on someone's door to pay back the money.
So, Vinay, you are also using, eKYC and IndiaStack in certain areas. Can you tell us about the experience that you all have been able to innovate on, which might not have been traditionally possible in the earlier days?
Sanjay, I don't think I would have done a startup if eKYC was not there, frankly. So the simple reason is, I've been doing KYC through my life, either opening liabilities or asset accounts. Just to open a simple account, the number of paperwork, ops team involved, the data to be recorded, to be kept. I mean, it was costing around anywhere between $10 to $30 just to open one account. With those kind of economics, it is really difficult to do a meaningful startup where we wanting to make money. So eKYC is a very, very important part of our business. And what we do is with eKYC, it is practically, you can enable anybody. In our case, it is an employer who's enabled to do his own, who becomes a mini bank in himself. And he can practically, Sanjay, onboard all the employees himself without a need of anybody from us to walk in.
So, Deepak, on the whole area of IndiaStack, and your role is Chief Digital Officer. But really, if you think about the bank, can there be does that mean that there is a non-digital part of the bank and that has to just eventually go away, one would imagine? So really, you're running the future bank in some ways, right? How is the bank seeing some of these digitization that are coming as, foundational elements from the government and in utilizing these?
So I think digital in itself, I keep saying, is not something which is outside whatever we do in the core domain of the bank. It's pretty much integrated with our core strategy. And the core strategy, as I said, it can be loan book growth, it can be cost to income ratios, it can be managing risk better, it can be about reducing the cost of acquisition, customer experience, and obviously digital plays a role in whatever are the core strategy. And more so if we look at the choice, while we would all love the entire bank to move on to one direction, which is a bank of tomorrow or future. But the reality is our customers are customers of yesterday, customers of today, and customers of tomorrow. A lot of customers with wealth are customers of yesterday. Because your wealth accumulation stage in a life is typically when you are 40, 45 plus. Your consumption stage
55 plus.
Depends. In Bangalore, people make money much faster. So I'm sure
25 plus.
So that's why I've lowered the age. When I come here, I say, no, you can make, even at the age of 30, you can make. But yeah, that's the average I'm talking of, old economy. But yeah, by the time you actually start accumulating a lot of money, you are north of 45. Typically in the age of 30 to 40, 45 is when people are in the consumption stage of life. So they are either building assets, buying house, taking loan, and obviously at a very early stage, which is early millennials, is where they probably are not saving. They are more to consumption. So when we look at any of our core products, it's focused on each of the three. So for example, a first credit card would be taken by someone who's in the first job. So that's where experience of giving something which is digital, seamless, real-time, on the fly is more appreciated than probably someone buying a home loan or taking a house. Because there your buying cycle itself is much longer. You don't buy a house on the fly. But that doesn't mean that you don't crunch the timelines there. Obviously the back of data, we have been working with a couple of state governments now where all the land records are going on digital. There is as it moves on to blockchain, you have a lat long and the identity of the sale and purchase. Your entire legal technical process today, whether you do a loan against property or you do home loan, you can crunch it significantly.
Right.
So I think as we see, be it India's stack, be it the states, the way property registration documents, the credit data is available. But let me tell you, none of this is going to happen at the expense of banks taking additional risk. I think that is one thing that fundamentally banks are conservative. Banks will continue to remain conservative. Even today, when we look at alternate lending as a platform, what we are doing is we are not taking necessarily decision-basis data, but we are saying this data we will continue to study over a period of 12 months to 18 months, while I still take the credit decision basis my traditional model, but at some stage I'll have enough confidence to say that these data points are equally credible for me to take a credit decision, because internally we believe that in lending business, your return on capital is more important. Return of capital is more important than return on capital. I mean, lending is one business where you are betting your 97 rupee for a 3 rupee return. So just imagine, you don't need, even if 10% of your customers default, you have to fold your shop and go back home. So I think it's a very, very simple business, the way it may look like, but frankly, it's a very complex business to run. We are realizing, even on business loan, some very interesting data points, which only you can learn if you have probably data of 6, 8, 10 years. How business cycles can impact the repayment of loan. How some standalone isolated events can impact the entire economy. And more importantly, we are seeing a very different kind of a fraud that's happening in business loan today. A lot of us used to trust credit bureau. Now we have seen there are guys who go and defraud 6 banks at a time, because they will take loan from 6 banks. they know if they default one bank, the credit bureau will get hit. So at one go, they will just stop paying all the 6. So I think there are these inherent risks in the business. And obviously, as I said, when we do transformation, transformation is also on the risk side transformation, not just customer experience and customer acquisition.
It's very interesting. Actually, there's so many points that you brought up that are intriguing for the entrepreneurs that are sitting in the room here, because we have seen payments companies being built over the last 4 or 5 years, or several attempts of them, and something like PhonePe going from 0 to 25%, 30% of UPI transactions within a year, and with an astronomical growth. But from what you're implying, really, lending or lending startups cannot be built sort of at this breakneck pace, right? They have to be built in a certain, with a certain cadence. So Gaurav, when you guys look at, again, as a startup, typically you're trying to get to the, you're pedaling as fast as you can, and you do take a few more chances than an established institution. How do you guys see, the time horizon it's going to take to build this into a strong business?
So I think you're right, and Deepak is also right. It's not, I think the first thing, it's not a winner-take-all business, right? Unlike payments and let's say maybe e-commerce or taxi. And so the need for speed per se is not necessarily there in lending. That said, we are still venture-backed companies. Nobody's going to wait for 20 years to sort of generate returns. So I think the idea, at least what we've done, is in the first 2 or 3 years, is really give a lot more loans, keep them shorter tenure, so you actually start to see credit cycles. So we never gave 3-year loans for the first 2 years of our life cycle. They were always 3 months, 6 months loans, which were not very interesting from a revenue or an income perspective, but from a credit data perspective, they were very useful. So you start to see cycles. You can at least understand what default patterns will look like. And now, as we sort of have a very well-controlled default rate, now we're starting to give longer-term loans, which obviously end up making a lot more money. And I think you cannot sort of discount the fact, like I said, there is a lot of fin in this fintech space in lending. So don't discount the fact that you do need some amount of physical infrastructures. And so, to very respectfully, Deepak, we use a lot of data, alternate data, but it's a question of it's traditionally approved data. So we get a bank statement through an SMS, which is the most interesting data set that we look at. So it's not just about looking at the sexy data of Facebook, LinkedIn. That's just very 5% of what we or any other lender would do. You need good traditional income generating data. It's just a question of how do you get that data through what channels?
So Praveen, you've been interacting a lot with the banks, and to what Gaurav was saying about shorter tenure loans. With the payments transactions going digital, and with Bharat Bill Pay coming into play, and and GST from the SME perspective, a lot of this data is digitized. So we've been talking about TRC and in other ways. Can you talk a little bit about some of these new concepts which are different from the traditional asset-backed lending or personal loans and things like that? How are new ways being evaluated by the institutions?
Yeah, so with this whole digital infrastructure coming into place, the cost of delivering credit and the cost of collecting also has become, completely, the cost has become completely low. It got lowered. Now, previously, people used to make money typically on a $50,000 rupee loan, or a 60,000 rupee loan, or a 100,000 rupee loan. But now, like Gaurav is doing, Gaurav's company is doing, you can still deliver credit for a small merchant at 15,000 rupees, still make money, collect money, and then still make money on that particular loan. Now, the idea is, most of these people who don't have enough opportunities to create data or create a profile about themselves, the whole TRC model, which is tenure, revolving credit, and managed churn model, will allow people to, lend small amounts multiple number of times and help the borrower build a profile of himself. And even for the lender, what this will do is this will basically ensure that the risk he's taking is very, very small. The amount of risk he's taking is very, very small. And when he does 8 such cycles or 10 such cycles, he has enough data, and his models will become more trained on the data which is coming back from the field, basically the performance, loan servicing data and loan performance data. And then he can underwrite a bigger loan for him if he feels it's a good way of doing things. So what this data-driven lending is going to do is they're not going to say the set loan product. I have a 1 lakh loan product or a 2 lakh loan product. What it will do is it'll basically say, can you give me the data about your last 15 days, your per payments data for the last 15 days time, and can I assemble a loan product just based on that last 15 days data? You know, say for example, if the shopkeeper has sold 10,000 rupees worth of goods, now a capital float might think, you know, I want to give 150% of that amount as the loan to this person, and this person will repay pretty much on a daily basis or a weekly basis. With UPI e-mandates coming into play, it's just a button. You know, there would not be a need to deposit checks or collect checks and so on and so forth. So those advances are being leveraged upon, and companies, NBFCs and banks are building new products and attacking new borrower pools is what my sense is.
So basically you're saying possibly smaller ticket sizes, very short application cycle to receive the loan, money is disbursed to you in your bank account through UPI. Repayments also you're doing
through UPI.
Mandates for repayments.
It's low value and high volume. That's what we're talking about. That's the future.
Got it. Let's look to the audience a little bit. You know, any questions? Yes, please.
My question is with respect to lending marketplaces and their partnerships with banks. I think you know pertinent to Gaurav and Deepak. My question is, given that the partnership actually depends on the models and everything that's built by the B2C lenders, right? The marketplaces. Do you guys feel that?
So is this a partnership?
So how will banks and fintechs interact in this new world? Is that what it is?
No. My question is, as a bank, when there's so many options that are being presented to you, right? There's so many other lenders who are coming to you for presenting these options. In terms of the models that they're presenting to you, how do you guys distinguish in terms of who to go with, from the bank's perspective and from the startup's perspective? How do you guys think about how to present yourself to the bank?
Good question. So apart from whatever banks do organically, there are still a lot of niche or sectors, as Gaurav also rightly spoke about, that banks have not focused on. Right? So, for example, banks have traditionally looked at a lending model where your income and your expenses are the two parameters, and credit bureau check basis, more or less, you take a call on credit. The new set of credit calls are taken based on the flow-based lending. Now, for example, the flow-based lending banks themselves are adapting to figuring out. There are new lending models where at this point of consumption, or there are at source lending which is built in. So you don't come and ask for money. For example, we have been working with a partner where at the time of checkout, as a consumer, you can get credit. Traditional model was you needed a credit card to avail credit. Now we are saying plastic is not required. You need credit, right? You don't need a card. Card is a form factor, credit is a requirement. So as you start reimagining this entire credit business, it can be for SMEs, it can be for individuals. I think a lot of such opportunities, I would say fintechs or startups in lending space have tried to address. And banks see a great value working with them because this is not something you do day to day. So while you continue to optimize and make your existing businesses become better, you partner at times. For example, we just launched consumer lending bank. Kotak was not in consumer finance business. So we said, how do we get started? One is obviously we wanted to build our own platform, get into this space like Bajaj and some of the others do. But we said if we have to quickly get into the market, let's work with those who have an online consumer finance model, those who have access to consumer, merchants, e-commerce site. And we jointly developed that, and within about 6 weeks, we were ready to roll out. And in the last 3 months, we probably partnered with 5 or 6 such players who had relatively decent scale. It helped us learn the business. Second, for them, they got access to a much larger customer. And they had also probably the access to the merchants. So I think such partnerships are always win-win about what you bring on table as a lending partner or a fintech or a startup, and what banks' core gaps or requirements or intent are. And I think that's where you find the sweet spot in any partnership.
So in the old world, I mean, you always had this animal called the DSA network, right? In the new world, what the banks will look for is, the loan service provider kind of a technology company that actually has the customer or the borrower pool and the data about the borrower pool. And in some cases, banks will also partner with you if you have an underwriting engine and if you have the underwriting algorithms as well. So in the new world, where the opportunities are, this whole concept of loan service providers who will entirely manage the experience for the end customer. There's a huge gap there because there's a huge opportunity there, and people who want to build companies there, I think banks will be ready to partner with you there.
But Praveen, I'm going to be a little provocative here, right? Sure. The word is partner, right? And I think there was an article in one of the US newspapers a couple of days ago, right, where the fintechs say, I just don't want to deal with the large banks because all they're doing is stealing my IP, right? Of course, that is also not fair to the banks because the banks are also looking to innovate on their products and they're seeing some of these innovations, right? So it might appear like, the IP was stolen, but really the banks are also going down that path and, have every right to hire a tech company to build out as Deepak was talking about, right? So I think there are 2 or 3 levels to answer, your question, and I'd like the audience also, the panel also to chip in. One is, am I a vendor to the bank? Am I providing technology that the bank is going to bring to market, right? Kotak 811 might have been built by the bank, might have been built by one of their integrators, or they may have bought a technology. But whoever built that is clearly a vendor, and the bank has brought this out to the market, right? Have no illusions about that, right? There are large companies that can be built that way that are vendors to banks, but don't imagine that you're a partner there. You're pretty much a vendor in that case, and that's what your business is. There are other extremes where companies say, look, I'm going to go work with the bank, I'm going to take them into a new area that they have not been in, and the bank is willing to see me as a partner. I'm on a revenue share business model. It may even be a co-branded model. So that is sort of partnership type of a model. So these are the 2 things to think about, right? And of course, the third extreme is, I'm going to get a license myself and I'm going to be the bank myself, and that's where you're now manifesting as a competitor. So you need to be very clear, right? There's no right or wrong in this business, but don't expect to go to a bank that is very strong in a certain area and expect to partner with them if you're a startup. You're likely to be a vendor to them at best. There may be a smaller bank that you could partner with because you're bringing them into a new domain, right? So be careful about what your expectations and aspirations are when you're trying to work with the bank, and choose your banking partner or customer appropriately. Right? I'd like you guys to also, because you both have worked both partners and worked with banks. How do you see this?
Yeah, so I think that's a great question, right? I mean, Sanjay hit the nail on the head. You got to know what your business model is. Are you an online DSA? And very respectfully, the new LSB model is somewhat of an online DSA type model, right? I think where our platform adds hopefully a lot more value is because we have our skin in the game, and that's where a partner or a bank starts to treat you like a partner, because I know how to lend. I go to a bank only after I've seen performance data of 6 to 12 months on my loans. I'm not just somebody supplying leads. I sort of drive the decision making in terms of underwriting. So we are actually adding value in the process from the bank side as well as from the customer experience, because we control the customer experience. So I think that is the 2 most critical aspects to get the bank to honestly treat you like a partner. And then honestly, there are some banks you don't want to work with, right? Or some large NBFCs, like if I do consumer loans, I don't want to go work with a Bajaj. I mean, they are great at that space, but I'm not adding any value to them at that point in time.
Yeah, so Sanjay, same thing. When we're looking to partner a bank, typically what we look at is, what is the value we are adding to the bank? Is that value quickly replicable? In our case, for example, we are bringing in the payroll tech, which is not, bank's core business. Being on both sides of the table, I know the first thing the bank will ask you, why should I go with you? Most probably I'm doing it myself. So you have an answer for that.
I think as a startup, don't hesitate to sort of drive through regulatory loopholes or rather regulatory hurdles, right? Getting an NBFC license is hard, maintaining one is hard, but at the end of the day, that adds value as well.
Great. So Deepak, would you like to comment in terms of, you know, you all have worked with a lot of startups and partnered and also bought from them. How do you see this, right? Just a little more direct answer to his question in terms of what type of potential startups in this room should be looking at a large bank like a Kotak to work with? I mean, whether it's you or one of the other large players in the sector.
So I think there are three broader ways in which we put all the startups. There are some startups where we compete head on. And I think no qualms in admitting it, because you are looking at same pie of the market. You're probably customer segment, intent, product. A lot of those are similar. And we obviously filter that out, because then there's no point wasting each other's time where you know that your interests are not aligned. The other two models which are relevant, and I think you touched that. One is obviously where we do collaboration. Both bring value, depending on either through our APIs or we support and we power some of these startups, or they end up creating something working with us. But I think our large focus is on the third, which is co-create. Because this is something where we see a greater value, and I keep telling startups, don't think you are IT companies of old world, where you have developed a product, you can just go and sell a product and you can monetize it. I think there is a long way. I mean, before you think you can be a next TCS or IBM or Infosys, I think you have to admit that you are not the one. You have just started. I think you are testing water. You have to figure out whether you want to be in B2B, B2C. A lot of them, they want to be in both. Their business models are not clear. They want to obviously get into a SaaS model. They want to, so model is fine, but I think unless you co-create a solution which adds value and which is scalable, you're not going to find that sweet spot. But we have been working with a lot of startups. I would say in last almost 1 year, we have got almost 30 startups who have worked with us very, very closely. I'm not referring to lending alone, I'm talking broadly. But they were from set of 200 odd startups that we would have initially started our journey. So they go through level of filter, and we put a 5 different prism through which we evaluate in terms of feasibility, scalability, viability, acceptability, and desirability. And that's what I tell my team, that apply these 5 principles when you evaluate anyone. And if we think they fit the bill, bring them on. The model may not be perfect, doesn't matter. We will work together as long as we have identified a customer segment, there is a niche, there is a problem that we are solving, and if that problem is worth solving, I think we will invest equal amount of time and resources to make that happen.
I think that's amazing. It's really good to hear that the bank has such a structured program here for co-creation. Any other questions from the audience? Yes, please. Just go ahead and ask. We're close by.
Sure. So I mean, yeah. So the question was, how good are we at collections, or how good is the model versus how frequency do we need to collect, right? We've got 4 or 5 different products that attack different sort of verticals. So from a mid to tier size business to a small kirana to a consumer, the models obviously are different across each product segment. That said, I think we have an in-house collection infrastructure, which is a call center and a few people feet on street, but we also have outsourced sort of collection agencies. If the question is how frequently, we use them on a daily basis, right? Because I think the point is, how low can you keep your NPA cost? So today that's about 1.5% for us, which is sort of well within the numbers that we sort of plan for. But you can't get away from this collections model, right? We do a lot of automation on that. So early warnings using the app that's on the phone, we get triggers and say, okay, in 20 days, this guy could be a defaulter. But you still need somebody to pick up the phone and say, hey, 20 days later, your payment is coming. Please make sure it sort of comes. We do a taxi loan product where we have a GPS in the car. So I know at any point in time how many kilometers the taxi should be driving for that week. So if he's not done his 200 kilometers this week, I know, okay, next 3 days, please drive another 50 kilometers. But I need a guy, or I need a person to say, go to his house and say, please drive you another 50 kilometers, right?
Great. Deepak, I have a question for you. Were you going to comment on his point?
No, I just thought of a very interesting anecdote, which I said I must add on. while we all love to drive our car fast, but I think I always say that make sure your brakes are good. So, without good brake and a stable vehicle, you're going to fly off the road. So this is pretty much, if you ask me, how I look at lending as a business. So make sure your risk, your collections, your controls are good. If it's good, you can really go at a high speed.
Now I know why Deepak comes to Bangalore. We don't use our accelerator at all. So I had one last topic that I wanted to briefly touch upon. So one of the big things that's happening here is the separation of the payment instrument from the provider, right? And in some ways, UPI has done that because I can use my Kotak application without having an account with you, but with, say, IDFC Bank and do transactions. And that allows for two things, right? Because it allows me to technically attach a credit instrument, whether it's a personal loan or whatever, to a payment instrument issued by somebody else, technically speaking. And secondly, even for the same credit instrument, the same lender can provide me a different rate from what they would provide Praveen, for example, because my credit rating might not be as good, or I might be over leveraged or whatever. However, today we still see, home loan 8.75% is what is advertised with somebody 8.3%. It's sort of broadly one size fits all. When do you see realistically, this becoming mainstream, where actually you'll be able to attach, a loan from somebody to a payment instrument by somebody else, and secondly, get a differential rate based on the customer itself? It's a little bit off, thinking into the hopefully not too distant future.
I think most of the financial products, the way it exists today, will become commodity. It's not just payments. It can be investments, it's broking, it's loans. You just put everything, because if a product is designed around fee and charges and rates, it's a commodity. A home loan at 8.35% is any day better than 8.5%. It doesn't need any brilliance to know where I will click, right? So I think that's something which is given, and anyone who doesn't accept is just trying to fool themselves, probably living in a Kodak moment. And that's what I strongly believe. Question is, if this is the reality, what do you do? And that's where I think a lot of focus in some of the organizations, including Kotak, is going back to say that look at customer. And there's no one customer. Each customer is an individual. And we now coined this word internally to say N is equal to 1, that when you have data, you have the way to understand customer. What are you doing with that customer, which is done only for that customer? So, for example, if 5 of us are sitting together and we have different relationship levels with the bank, same bank, why should I have 8.35 or 8.5 as a loan? First thing first, I need to know whether you even need a loan. For example, there's a very interesting data that we looked at internally to say that if we find that a vehicle has gone for X number of repairs or garage in a year, probably somebody will look at buying a new car. Now, question is, with data, what are you doing? One is when I've already decided to buy a car, the car dealer will decide who will finance my loan. But if I have the data that you have a problem with your car because you're swiping your card or you probably made a transaction, why can't I come back and say, hey, I know that based this is interest, these are the new models, would you be interested in knowing more? And when you log in, knowing that I show you a contextual content which is very different than probably somebody else is going to see. So I think the business is moving beyond the way financial products were designed to more around customer experience. Financial products can be disintermediated, but not the experience.
Wonderful. Any comments, Vinay and Gaurav?
Yeah. Sanjay, the pricing of loan to consumers, risk-based pricing has been always, banks have been trying to do that, but with the new infrastructure available, it is so much more easier to do. To give you an example of how the risk-based pricing typically in unsecured lending would work is, today, if you're a TCS employee, every employee gets a single personal loan rate. But going forward, I think with each passing year, to what Deepak was saying, every single TCS employee may also be segregated, and for all you know, will be segregated depending on what is his other parameters, other data analytics adding up to. So home loan, that in a sense is slightly different because you got an underlying security, and which is why the price differentiation between 8.3 and 8.5 will not be so much. But the maximum spread of risk-based pricing is going to be an unsecured lending, is my view.
I think at the end of the day, price is still the best experience, unfortunately, in India, right? And the fintechs have a long way to catch up in terms of pricing to a bank. I can give a loan in 20 minutes, but if Kotak can give it at 500 basis points cheaper, I'm going to wait the 3 weeks. Not that you take 3 weeks, but anybody else would take 3 to 4 weeks. I'll wait those 4 weeks, right? If 500 basis points is a lot. So I think till fintechs can grow and scale and actually be competitive on price as well as experience, that's when you start to really see this best pricing coming in.
Might probably be, as Praveen was talking about TRC earlier, right? Shorter tenure loans. There probably the risk-based pricing and the sensitivity towards the price might be less because it's a shorter duration, right? Great. Praveen, you want to add something to this?
To Gaurav's point, there is a segment that can wait for 2 weeks or 3 weeks, but the small and medium segment will not wait for that. Your customer, right? He was saying it's okay even if the interest rate is higher, but I'm getting money when I need it, and I can use it for my expense and so on and so forth. So I think that segment will not wait. They will just grab whichever. Yeah.
Great. Next Fintech Unicorn is in lending. How many people here believe that now? Come on, guys. It's Friday afternoon. Let's have a show of hands. Why were you wasting your Friday afternoon sitting here if you didn't believe that? Gentlemen, thank you so much for a wonderful panel. And I think we're set for now. Shripati is going to help us all with some wonderful gifts. Thank you, everyone, for being a wonderful audience.